If you're a director of a company and you don't maintain proper books and records, you can become personally liable for the debts of a company. That's bad. So today I want to talk about what books and records you need to keep and how it can end up becoming a big problem for you if you get this wrong. Hi everyone, Liam Bailey here from O'Brien Palmer, and today I want to talk to you about books and records of the company. Now I know that might not seem like the most interesting topic for a conversation, but it is really important. And in case you only watched the first 30 seconds of this, here's why. It's important to note that in the last financial year, over 11,000 companies entered into a form of external administration in Australia. 27% of these companies were in the building and construction sector and 15% in food and hospitality. So at the moment, company insolvencies are on the rise, and it's important to make sure that you protect yourself just in case the worst happens. So what actually are the obligations to keep books and records that a director has? Section 286 of the Corporations Act requires that a company maintain financial records that correctly explain its financial position, performance, and its transactions, and allow for the company records to be audited externally for accuracy. It also requires that you hold on to these records for a period of 7 years after the date. It's also important to note Section 588E of the Corporations Act that says that a company is presumed to be insolvent if a director cannot provide sufficient records to comply with the previous section. Why is this important? A director of an insolvent company becomes personally liable for the debts incurred while the company was insolvent. So if you can't provide the records of the company for a year before the company goes into liquidation, you can become personally liable for the debts incurred that year. The Australian Securities and Investments Commission provides significant guidance to directors on what actual books and records need to be maintained. And you can check below for a link to the ASIC website to see what it says about what books and records you should maintain. Considering ASIC is the organisation that will actually prosecute directors for breaches of duty, it's best to get the information straight from the horse's mouth. A couple of important things to consider before we get into exactly what those books and records that you should maintain are. You should note that if the books and records are maintained by a third party such as your accountant, it's still your obligation to ensure that they're maintained and preserved, even if they're in somebody else's possession. So don't rely solely on your accountant to ensure that you comply with this duty. Electronic accounting packages such as Xero and MYOB are a fantastic tool for helping you maintain a proper set of accounts. However, these accounts are only as good as the source records upon which they're based. So it's a great practice to get into the habit of scanning your books and records and attaching them to the transactions that you record in Xero. Remember, part of the obligation in maintaining books and records is to maintain them to a standard that an external party can audit and review them to assess the accuracy. So if those records are attached to the electronic accounts, you don't need to hold on to huge piles of paper. So let's have a quick look now at what are the records that you should actually be keeping. Generally, these are invoices, receipts, sales reports, and purchase orders. All the documents that give evidence to the transactions that your company engages in. But let's go through them specifically. Examples of the records that you should keep. Financial statements. This includes things like profit and loss statements, balance sheets, depreciation schedules, and tax returns. A general ledger of your transactions, which can be reconciled against your bank statements if at all possible. Cash records, including cash receipts, bank statements, loan documents and loan account statements, sales and debtor records, invoices and statements received and paid, especially any unpaid invoices, copies of all your wage records and superannuation records for your employees, and relevant registers, including asset registers and valuations and evidence of calculated depreciation. Deeds and legal agreements. All of these should be kept and where possible attached to the transaction records in your electronic accounting packages. But what else is good practice to keep? Directors really should consider preparing monthly statements of their financial position and performance of their companies. Holding on to the summaries of their company's financial position can be subsequently used as evidence that you have actually complied with your duties as a director and monitor the performance and financial position of your company. This can be really important when establishing any defences that anyone might want to bring against you for breaching those duties. Also, it might be a tad cliche, but knowledge is power in your situation as a director. Knowing the financial position of your company allows you to be able to obtain the help that you need when the company is facing financial difficulty and to be able to obtain accurate and specific advice on the circumstances your company is in. If you don't have the records to be able to show exactly the position of your company, how can you get the assistance that you need specific to the circumstances that you're in? There's also a simple efficiency factor here. All the best records in the world may end up needing to be provided to the tax officer or an external auditor if called upon. And you don't want to have to go back in and try and recreate those records to a standard that's required So maintaining proper records as you go is really a great idea. In this regard, the benefits of consulting with your accountant cannot be understated. It's really important that if you're going to go to all the efforts of preserving proper books and records of your company and maintaining management accounts, that they're established in such a way to ensure that they comply with your duties and are incredibly useful for you to any external providers that you might wish to speak with. Keeping proper books and records is not only a legal obligation as a director, but best practice for you in ensuring that your business is in the best hands and able to survive any financial difficulties it might face. So talk to your accountant today. As a registered liquidator, we don't only take appointments from directors, but sometimes we're appointed under court order for the benefit of creditors of the company. And particularly, we take work from the ATO in relation to winding up companies that haven't paid their tax debts. In a couple of recent matters where we were appointed by the ATO as the liquidator of the company, the directors came to us and admitted that they had not maintained any books and records at all. Unfortunately, as a consequence, that meant that they were personally liable for the totality of the unpaid debts of the company. In this case, hundreds of thousands of dollars of unpaid tax that they would not have otherwise been personally liable for. As always, if you've got any questions about this director's duty, proper books and records maintained, or any aspects of best practice for managing your companies, please get in contact with us today. Section 286, Section 286, 286, 286. Yeah.
Bloody hell.
Got to get their attention.
Yeah, that's good. Beautiful. Have you got a story? I know.
Let me think how best to do that. No, I don't want to say the last bit.